The dollar is epicenter for much of what's going on in the world. Central bank policies wish it was stronger outside the U.S., and funding issues that have arisen, a lot of it is dollars. It's all about getting dollars. Your thoughts?
Yeah, this is clearly, I think, the strength of the dollar is coming from the rest of the world. China's slowing, the Eurozone's slowing. The U.S. is now slowing with a big of a lag given the manufacturing recession that we're in. And I think what you're seeing is defense is kind of the best offense in FX. And so along with the U.S. dollar, the yen and the Swiss franc are also currencies that are performing well in this environment. So I think what you're seeing is as the global economy cools, as especially the big participants outside the U.S. are cooling, this is driving demand for U.S. dollars.
Now, if the demand for dollars signaled issues like funding, would the dollar coming off its highs and moderating be the signal that there's an all clear on some of the negatives in the marketplace?
Well, it's a good point, too, because I think the liquidity side is important because it's reinforcing the risk appetite. So as we've seen tighter liquidity conditions, we're seeing equity sell off, which reinforces the strength of the dollar, especially against emerging markets. But the setup here is really about a bigger picture. It's about trade wars. It's about the impact of trade on the global economy. And so I think to see a full reversal in risk sentiment where the dollar starts to weaken again, what you're actually going to need is a reversal of the tariffs, not just a pause. You're also going to need the Fed to cut rates. If the Fed introduces permanent open market operations, those things will satisfy market conditions. It'll cause a bit of a short squeeze in risk assets, but that will not reverse the trend that we've seen in the dollar until the global economy stabilizes, which we believe is still probably 3 to 6 months off.
You know, Mark, it's surprising for me to hear you say that the dollar really, is going to benefit. We're all going to benefit by easing and having the market, the Fed lower rates. Now, I understand that's what the stock market wants. I'm looking at Fed fund futures. But at the end of the day, doesn't that just make us another character in the manipulation theater?
I think it's part of it. I think what's important to think about is two-year rate differentials. If you look at the U.S. versus the G9, the dollar's doing the opposite. So even if rates are rallying more than the rest of the G10, the dollar's strengthening. And I think that reinforces what the biggest driver for currency markets is really the state of the U.S. economy versus the rest of the world. And think about why the Fed's easing. The Fed is easing because of the external risk that's coming from the rest of the world. That's a principal driver alongside the slowing that we're seeing in the U.S. side. So I think when you kind of combine those two things, this is an environment that it's, yes, the U.S. is slowing, but the real big concern is really China and Europe.